Hello and welcome to the Richards Report. This is the second part of my two-part series interview with Chris Judd. As we all know, he's an AFL champion, a Brownlow medalist and a premiership captain. But what you may not know is the level of detail he goes into in analysing potential investments. In part one of the interview, Chris detailed his sophisticated investment strategy, and I highly recommend you also listen to that as it outlines the framework he uses when analysing the businesses. In this episode of the podcast, Chris gives us some examples of companies that he has actually invested in, and we discuss why he did so. We also chat about what he reads, the best advice he's ever received, the worst advice he's ever received, his favourite book, and much more. I hope you enjoy it, and here comes the intro.
You're listening to The Richards Report, where we will speak with investment experts from around the country. We will cut through the jargon to allow you to make more insightful investment decisions for your future. This is The Richards Report.
Now, you and I caught up recently, and you brought up something that I've never heard of before, but the concept of East Coast versus West Coast investing. Can you explain to me and the listeners what the difference is and what you've seen over your time living in both Perth and Melbourne?
Yeah, well, it's completely different. A lot of people investing out of Perth and the brokers over there. A lot of them invest in shell companies or mining startups or businesses that have a level of risk attached which people on the East Coast would just never, in their wildest dreams, look at. Yep. But one of the things they don't do is they often don't attach any debt to that. Largely, you can't margin loan against, micro cap companies, yep, or the tiniest ones. But they get their risk. There's plenty of risk attached, largely given to the size of the company. East Coast, most East Coast investors will invest in much larger, more established businesses. If they want to get a little bit more sizzle out of their investment, they'll attach some debt to that, and that's where they get their leverage, if you like. But the leverage on the West Coast is more linked to just the minuscule size of the companies, yep, and the enormous change to the valuation of those companies if something goes right. And if something goes wrong, your downside is essentially capped. Like the enterprise value of a mining shell is always going to be about $1 million, yep, even if it's got no cash in the bank. Yep. So if you invest in a shell and it's worth $3 million with $1.5 million in the bank, it's unlikely to lose much more than about $500,000 because there's always going to be an inherent value in having a listed entity that you can drop a new project into. Great
insight from Eve, who's just lived in Melbourne and Sydney, to hear that this strategy is quite prevalent over in WA and Perth. I can remember reading recently that investors make the most and the safest money when they do things that other people don't want to do. Is it fair to say that this is a little of what you do, but it's hard to do this? You're by no means moving with the crowd with your investing. Do you have enough conviction to buy when everyone else is selling? And are you human? Do you second guess yourself sometimes?
Yeah, all the time. And you've constantly got to test the sort of confirmation bias that you start to develop when you've made an investment. It's easy, I'll have brokers send me information all the time. And that information is always to confirm an investment I made with them is a good one. Yeah. So it's easy to develop a bit of an echo chamber where decisions you've made are constantly just being reinforced. But I think, the more work you've done on something, the more times you've been to AGMs or met with management, the more confidence you can have in making an investment, even if the price is going the opposite way to the one you want. But you just got to be comfortable that there's that element of risk. No one actually knows what's going to happen, and sometimes you just got to have a crack.
Yep. Now, before we go on any further, I'd just like to mention that this podcast is brought to you by Six Park. Six Park, the low-cost provider of the highest quality automated investment management service. Compare the fees and the experience of the Six Park team with any other automated investment advisor. Check us out at sixpark.com.au. Chris, it's fair to say that this investing style isn't conducive to people that are already short on time. You actually view it as a full-time job, don't you?
Yeah, well, I think one of the keys is you have to be able to move really quickly. So you may only get small opportunities EGM may only be for half a day where there's some liquidity in a stock and you want to exit that position. So if you've got a full-time job and you don't have time to do enough research or go to the AGMs or meet management or investor presentations when they arise through different brokers, I really think this strategy's fraught with danger. And if you don't have that ability to be able to keep track of markets and take advantage of liquidity opportunities when they arise, I think this strategy's not for you.
Yeah. Even though that, I still think it's fascinating just to hear, I guess, a strategy that's worked for you. Now, it doesn't have to be two current examples that you might be investing in, but can you give us some examples of companies that you may have invested in the past?
Maybe a clean one's Paragon Healthcare, which is a little bit bigger than most of the companies I would invest in.
Paragon make medical supplies or?
They're the biggest distributor of medical supplies to hospitals in Australia.
Yep.
They're a roll-up, so that means that it's a company that
they've acquired other businesses.
Is regularly acquiring other businesses as part of their strategy. So I think since I've been in them, they've acquired 6 businesses, maybe 7. They acquired 4 major businesses at once 3 or 4 years ago, and that did a significant capital raising then. So that was a good opportunity to enter. And I guess from a macro trend, ageing population, the need for ageing populations to spend more on healthcare, it fitted in with that. They've got exclusive rights to a lot of things that they distribute, so they're not under the same amount of price pressures that companies that don't have exclusive rights for their distribution are. They've begun manufacturing their own products as well, so they've become vertically integrated, which was an attractive milestone.
Keeping that margin.
Yep, and that's a future area for growth. And they don't have a great multiple. Their PE is about low teens, between 10 and sort of 14 usually.
And off the top of my head, the ASX 200 might be about 15 right now. So
it's lower than, and particularly in health,
average.
Particularly when you compare it to other healthcare stocks.
True.
Where multiples are often in the 20s or 30s due to the safe nature of their earnings. So low multiple, which has been one of the challenges because they do make a profit and they pay a dividend, unlike most of the other stocks I invest in. But they've also got a software business in there, which would get multiples far in excess of their current business should it work out. So that's sort of an opportunity for a potential re-rating down the track.
And management must have impressed you too.
Management are great. So of the 13 businesses they've acquired, they're yet to have a miss. So that's really rare. Roll-ups, in my experience, sort of work until they don't.
Yep.
So they work really well, and then eventually they make an acquisition that's poor, or they have some struggle integrating some of the other acquisitions they've made, and they fall apart quite quickly. So Slater and Gordon experienced that. Vocus experienced that, albeit they look like they're fighting back.
Peter Lynch used to call that diversification.
Yeah. I mean, it is hard to find good businesses to buy, and then once you do buy them, challenging not to find any warts that you haven't exposed already, and to integrate all those people and products in with your existing business. So
we've got a huge listener base at the Richards Report. So
I'm aware of that.
Yeah, so no doubt. Let's keep an eye on the Paragon after the Richards Report bump.
That's right.
Just a little catalyst for the share price there. Okay, this is fascinating stuff. We really appreciate your openness to share this. I've just got a few more general questions here. Best investing advice you have ever received? Yeah,
I think the most important advice was backing the right people.
Yep.
I think as simple as that. And I actually think that would carry over to investments in businesses of any size, whether that's a huge top 50 business or a tiny little businesses like the ones I like, or an unlisted private business. I think having the right people in the right spots is the most important thing.
And I think it follows through to the football world too.
Yeah.
All right, the opposite. Worst advice? Something a bit different?
Not so much advice, but particularly early days, I probably overestimated the intelligence of people that have been in the industry for a long time. Just because they'd been in the industry for a long time, I assumed they knew a significant amount more than me. And now most people that have worked in the industry for a long time do and have, but it's not just a blind rule that because you've been in the industry for a long time, you're actually an expert at it.
Yep.
So that was probably...
And probably to back yourself
Yeah, not to underestimate your own knowledge. And that was the big benefit of actually working in the finance industry for a brief period, was to give you that confidence that the decisions you make are actually sound decisions.
You mentioned before that you banned yourself from reading the Financial Review on game day. Was this because the noise of the markets that you might read about could distract you during the game?
Yeah, I just found that sometimes I'd be thinking about stock ideas out on the field, and that wasn't conducive to playing well. So I stopped reading on mornings of games.
Okay, that's a fair point. Sometimes during games I'd be reading about not what I'd read earlier, but what I'd be reading in the paper tomorrow. but that was more related to the sports section, the business section. The noise is still there. How do you manage the noise now? Even though you may not be playing football, I'm sure when you invest, you've still got to read the paper and read opinions that are the opposite to what you've been thinking.
Yeah, look, it doesn't really stay with me now. And I'm pretty clear now. If I'm holding a stock that I just don't feel good about, I just don't hold it any longer. There's always going to be a new stock that comes up. I've had some examples.
You don't have to swing at everything.
No, and there's nothing wrong, with missing out on some stocks that go up. You haven't. The price doesn't actually determine, particularly in the short term, if you've been right or wrong. Over the long term, it essentially does. But if you're unsure about it, just give it a miss and save those pennies up for something you're sure about. So
a lot of active fund managers, and you are very active, say that if they can get 6 out of 10 stock calls correct, then they're happy. That means that in a good scenario, they're getting 40% wrong. How do you manage making wrong calls from time to time?
Yeah, well, I think I've been listening to a little bit of that recently too. It's been good to hear those anecdotes. Is it 59% you're a gun as an active fund manager?
Yeah, I think it's something like that.
Yeah. So that's good to hear. I think the key is your ticket size, more so than just the number you get right or wrong. It's getting a good chunk in on the winners is the real key. For me.
Playing the more quality than the quantity.
Yeah, I guess just milking the most out of your winners and letting them run. That's of most interest to me. And I don't have a clear strategy for how to do that. It's just I never really invest all of the money in a stock at once. So often the stocks I invest with are pretty small gardening type stakes. And then as you get to know management more, as you get more comfortable with the business and there's a dip in the price, you may accumulate more. And I think that's a good way of trying to eke the most out of companies you're really big believers in, rather than going all guns blazing when you're still getting to know the company essentially.
Chris, you're obviously very well read. Who do you recommend aspiring investors check out or read?
I like Grant Williams. He's got a blog, Things That Make You Go, I read Livewire in the mornings. I still read the newspaper, the Fin Review or the Australian.
With Grant, that's a paid service, but you can also get a free version of that too, can't you? I've read a few of his things. I think he's on Twitter too.
He's on Twitter, yeah. And his newsletter is paid. I'm not sure if there's a free service, but he does a free podcast, Adventures in Finance.
Okay.
Which is similar content. That's really macro.
Similar to the Richards Report.
Very similar. Not quite as high a level as the Richards Report, but that's very, very macro stuff. Essentially a lot of the reading will still just come from brokers and just articles that I come across that are related to different stocks that I'm trying to investigate.
Apart from me, who else is awesome on Twitter? Who do you like to follow?
I actually don't really use Twitter very much for investing.
Okay.
At all. I don't use Twitter much, full stop. I drop an article on there that I write each week on footy. But I don't use that much for investing, even though it's a really good source. I generally am trying to reduce the time I'm spending scrolling through my phone rather than increasing it.
Fair point. So what about podcasts then? What you mentioned one before. Any other podcasts?
No, Adventures in Finance is the main one I listen to. There's been a couple others I tried, but no, that's the main one that sticks out.
Okay. Do you have any mentors, and what have they taught you?
Yeah, so I've got a couple of guys out of Perth who are really strong mentors, and they've really, taught me everything about this way of investing. So one just referred to himself as the chairman. He's an ex-chairman of a broking company and now just a full-time investor. incredibly smart.
Shout out to the chairman.
Incredibly smart. Really lucky to be able to invest alongside him. Will take me to, when he's meeting management, I get to tag along and get that sort of access. So it's been really beneficial for me to be able to invest alongside a group, if you like.
That's a great opportunity, because this is something that if someone wanted to meet with management, most people might only be able to get to an AGM and be able to ask one or two questions, but to be able to sit in the same room and eyeball someone on either side of the table is a great opportunity, isn't it?
Yeah. I mean, the AGM is obviously a really important thing to go to. There's also investor briefings that broking houses will the roadshows they'll take management around to, and if you've got a good relationship with your broker, even if they're fund managers sitting in that, most investors should be able to sit in on that, because you're just one extra number. So that's something people can try and do. But very lucky to invest alongside those people to have those opportunities, because if you don't have a clear view on management, their capability and their strategy, if you don't have clear faith on that, I think it's fraught with danger investing a good chunk of money in their business.
Bit of a different question. Best book you've ever read, and this can be investing or
best book I've ever
non-investing
read
related.
would be Shantaram, I would have thought. The old Australian classic.
Oh, okay.
You're not familiar with Shantaram?
No, I'm not. I've heard of it, but I haven't.
I did love Shantaram. Yeah.
Okay. Tell us something we don't know about Chris Judd. I'm sure we've learnt a bit over this last however minutes, but is there anything else that we don't know? Because you're a man of many talents.
Am I meant to come up with something good or something bad?
Maybe we can come back to that, because it is a bit of a tough question to ask.
I make a good coffee in the morning.
Do you?
Yeah, a strong latte and a proper coffee machine.
Ah.
So if the investing goes bad, I may look to get a sleeve and a couple of crap tattoos and a big earring in my ear and become a barista.
And what is are you a flat white man, a latte?
Strong latte man.
A strong latte. Yeah. Okay. Here's one for you. The best call, best investment you've ever made.
It would probably be in a cobalt stock that I like. I won't give you the name, but it's a cobalt stock that's got a deposit in New South Wales.
And cobalt is used in batteries?
Yeah, so cobalt's one of the main minerals used in lithium-ion batteries. There's more cobalt in a lithium-ion battery than lithium, so the name's essentially misleading. You've got lithium, nickel, graphite and cobalt are the minerals used in those batteries. And the difference between cobalt to those other minerals is cobalt's not mined as a primary product.
Yep.
It's a byproduct of copper or nickel mines, so the ability to turn the tap on when demand increases is challenged. And adding to that, 65% of the world's cobalt is produced in the Dominican Republic of the Congo. Yep. And that's got its challenges politically, as I'm sure the Richards report would have pointed out historically.
Be very careful about investing in the Dominican Republic of Congo, but if it comes off...
this deposit's not in the Congo.
Oh, okay.
So
that's a relief.
Companies like Tesla, Apple are coming under pressure to show that they don't buy their cobalt from the Congo.
Okay.
Because it's a conflict zone and you've got artisanal mines with teenagers ripping out the minerals. Yep. So to have a cobalt deposit in a country like Australia is quite appealing for those companies. So that's been my favourite investment.
Okay, painted a bit of a rainbow there, but worst investment?
Worst investment?
And I've made plenty of these too, and I'm happy if you say this and I've erased it from my memory, but if you're happy to share any insight with you, we can also come back to that one too.
Look, I think it'd just be early days. I generally even I was in Slater and Gordon. Yep. I was in Slater and Gordon, bought, sold for the same price. It went up to almost $10.
Is it under 10 cents now?
Now it looks like it's, I think that the people who own the debt are going to acquire the business and the shareholders will lose pretty much everything. But I was in that and got a call from the Herald Sun saying, why'd you picked that it was going down, why'd you sell? Funnily enough, I didn't have a huge amount of shares in it either. They've gone through the registry and I didn't get back to him, but I actually missed the fact that it went up fourfold, and I also missed the downturn, but there was no strategy or anything.
Who made the call? Was it Robbo?
I know. It was just very strange. And Beck got a call too. It was with the super fund. So they called both of us, and but there was no brilliant strategy on my behalf. I just got tired of the stock doing nothing.
Another weird question I'm going to ask you. Any habits you're a big fan of?
Other than coffee?
coming back to the coffee, 1, 2, 3 person, 3 coffees
I'm
a day?
actually just starting to try and cut it down because my
cut it-
left eye's been fluttering all the
Okay.
time, and I'm told that's a.
I just thought that was because you were nervous being in the same room as me.
I'm told that's a reaction of too much caffeine, or if you're tired. So
What's too much for you? Because too
well,
much
I have a
is-
really strong coffee, so it's probably about 3 coffees in one
Oh,
in the
okay.
morning. So I have, a good 3 shots there, and then
Well, you're not
followed
really selling your coffees if you're putting 3 shots in them.
and then followed up with another 3-shotter. So even though it's
Oh.
only 2 coffees, it's
Yeah.
like I'm knocking over 6 by sort of lunchtime.
Yeah.
So that's probably too much too.
Yeah, a bit of an emotional roller coaster in the afternoon, coming express to the Judd household at 3 p.m.
That's right.
Chris, we really appreciate your honesty and the insight you've shared with us. I'm a big fan of investing passively and getting your returns by investing over different asset classes, not just equities. At Six Park, we're probably the antithesis of your style, but I think that it's healthy to discuss what other people do and the incredible level of detail that some people go to, yourself included. If you'd like to know more information about anything we've spoken about, go to the Richards Report blog at sixpark.com.au. I will have some links up where you can find more on Chris, his football career, or you can shoot me a question on Twitter at Richards_report. Chris, I know that you're not on Twitter much, but what is your Twitter handle?
CJ5.
That's it for this episode. Be sure to subscribe on iTunes as I'm going to be doing a new investing podcast each month. Before we go, I've got a favour to ask. As I've only just started out, I would appreciate a bit of your help. If you've enjoyed this episode of the podcast, please go to iTunes and leave some feedback. I'd really appreciate it. Chris, I'd appreciate it too. I'm Ted Richards, he's Chris Judd, and you've been listening to The Richards Report. Music outro.